Today we're going to focus on trading during earnings periods. We'll look at pre-earnings trades and post-earnings trades, but we'll also look at aggressive momentum trades, directional bets, volatility bets with no direction, and also volatility scalps. So there's something here for everyone. We will also interject the new scanner, which is our trade discovery facility, in bits and pieces as we go through these examples, and then we'll cover it comprehensively after these trade examples. But there is no more mystery as to how we find these trades. We'll start with our first pre-earnings pattern. I call this a directional bet on optimism. So one of the least recognized but most important phenomena surrounding this bull market is the amount of optimism that sets in the 2 weeks before earnings in the mega technology stocks. We're talking the FANG stocks. Now this is totally irrespective of whether the stocks have a history of beating earnings. In fact, many of them don't. But in the 2 weeks before earnings, there is a massive momentum rally into the event. What the scanner will help us see later is that while there is this 2-week pattern, sometimes 1 week or even just 3 days presents a better trading window, both with respect to consistency of the win rate and of course total returns. We'll start with 2 weeks here and address the other time periods when we cover the scanner. Let's look at a simple idea. Let's just buy a monthly call option in Alphabet 2 weeks before earnings and selling the call before the earnings announcement. So we'll get long a call, we'll go to custom earnings handling, we'll open the trade 14 days before earnings, and we will close the trade 1 day before earnings. We are not taking an earnings bet. This is a pre-earnings trade. And here are the results. We can see across the board, this has been a winner. And just to see what's happening, we can look at the stock price. This is a 2-year stock chart of Alphabet, where the blue E icons represent the earnings. What's so interesting here is that while the stock almost always rallies before earnings, you can see that with these little yellow arrows into the earnings, the stock goes down off of earnings a lot. In fact, that's what these yellow rectangles are. This is how many times Alphabet missed earnings. It's just a coin flip, but it never interferes with this optimism, this bullish momentum. While we're looking at this, we might as well look at the rest of FANG. So I'm just going to put the rest of the tickers in here, comma delimited. As I said, this works with all of the mega tech stocks, but what we need to do to find the best trades is to focus on the win rates. Netflix and Amazon are a coin flip. Even though the returns are positive, these aren't the best of breed. But a good trade turns into a great trade only after we do risk control. So let's drop a tight stop on these calls and also a tight limit. We'll go down to the close trade when section. We will close these long calls if they go up by 30% in a 2-week period. And we'll also close them if they go down by 30% in a 2-week period. All of a sudden, the trade is clearly in Alphabet and Facebook, not Apple, Netflix, or Amazon. So let's focus on those two. Now we can see the staggering returns, and we can see 15 wins on 1 loss if we held these two as a portfolio. And just so you know, we're not pulling a fast one on you, and that calls always work on these companies, we can just look at the 15 days after earnings. So we'll open 1 day after earnings and close 15 days after earnings. And these trades are actually negative. So this is in fact a pre-earnings momentum trade based on the personality of this bull market. While we're here, let's go ahead and look at another trade that's very similar. We'll go to custom earnings, and this time we're going to look to open the trade just 1 week before earnings, so 7 days before earnings and closing it the day before, as opposed to the 2 weeks before earnings trades we looked at with Google and Facebook. And this time we'll look at NVIDIA. So we're going to buy a call 7 days before earnings, close it the day before earnings, we'll put a stop and a limit, and we'll look at the last 3 years. And here we can see with NVIDIA, 11 wins and 1 loss with a 1,352 total return. And if you're wondering how I knew to look at NVIDIA a week before earnings, this is how. And now it's time. We're going to introduce the Pro Scanner, which is available to Trade Machine Pro members. We select Pro Scan, then we select By Strategy. We can choose any grouping of stocks, but for now, we'll use the S&P 500. Since we're looking at pre-earnings momentum trades, we're going to scroll down to the pre-earnings section. You'll note that we scan for 14-day, 7-day, and 3-day pre-earnings momentum trades. We'll select the 14-day since that's what we're looking at with Google. The scanner automatically sorts the results by win rate. And since the 14-day scan does not use a stop or limit, the highest win rate in this group of tickers is actually the tech gem Akamai, with 10 wins out of the last 11 earnings sessions for a 91% win rate. We can see a 38% average return per trade, and that includes the 1 loss. That's over 38% for just 14 days. The total backtest return is 426%. We can also see Marriott, which was another note we sent to Trade Machine members just a few weeks ago that continued in its pattern as well. Finally, we can see Google, and here are the results before we put in the stop or the limit. We can also sort our results by the total backtest return. So this is for the trader that's comfortable with a backtest that has shown a lower win rate but larger returns. Right now we're looking at backtests that are 3 years long, but we can activate the 2 and 1 year results as well by just tapping on the buttons. Let's now look at the 1 week back tests and just look at the 3 year results. So we'll tap on 7 days and we'll deactivate the other buttons. We can see NVDA here, which is the second result. This is a tech darling that has had immense pre-earnings momentum, showing 11 wins out of the last 12 pre-earnings sessions, with an average return of 39% in a week or 493%. For those of us that like trading the tech names, we can select the NASDAQ 100 and sharpen our scan results. We can find a familiar name as well, which is Microsoft at the top of the list, which has won for 3 years in a row the 1 week before earnings, showing an average trade return of 50% per week. Microsoft is one of those curiously forgotten tech names with nearly identical results, in fact better results to NVIDIA. Let's let the rest of the world forget about Microsoft. We will not. Now this 7-day pre-earnings backtest and the 3-day earnings backtest, which is really just a tight swing trade, do in fact implement a stop and limit of 40%. This is our first exposure to the Trade Machine Pro scanner, and all we have done so far is just look at a very small subset of another subset, which are pre-earnings scans, the momentum patterns. But this leads us to one of the other benefits of the Pro scanner. We can simply click on a ticker and it will load the backtest in our trade machine for us. So let's click on Microsoft, and here are our Microsoft results. 12 wins, no losses. And down here is where the limit gain and the stop loss have already been implemented. We can click on custom strategies and we'll see we are looking at, in fact, this 1 week trade. Here's a pro tip. If you put a comma after the ticker with no other tickers after it, you will only get one result in the backtester, which makes it run faster. For details on this functionality, we refer you to our user's manual video. Now let's focus on our second pre-earnings trade. And this is not a directional momentum bet. Rather, it's a volatility momentum bet. This trade takes no stock direction risk at all. We'll look at all of FANG again. And this time we're going to test buying an at-the-money straddle, but now we're going to go to custom earnings, and we're going to open the trade just 6 days before earnings, and we'll close it on the day of earnings. Now here's a note. All of the FANG stocks report earnings after the market closes. So when we close the position on the day of earnings, we're still not taking the earnings risk. If you do this with other companies, make sure you know what time they report earnings, and you may have to change this number to a 1 rather than a 0. Let's see the results. We've already got our strategies for Facebook and Google, and it looks like of the remaining ones, Apple looks the best. It has the highest return and also the highest win rate. Let's focus on Apple. Now you'll notice that we still have our strict limits and stop losses. And what we get is a 43% return over 7 earnings cycles. But remember, this is just a 6-day trade each time. So we're actually looking at an option trade with no directional bias that went up nearly 200% on an annualized level. If this type of trading fits your style, that is a trade that is delta neutral, but it does take on a little bit of volatility risk, you can go to the scanner by strategy, select your ticker group, go to the pre-earnings trades, and look under the 6-day pre-earnings long straddle. All right, so now we have our Apple pre-earnings trade, which is non-directional, and we can add that to our Alphabet and Facebook trades. Now this was slightly more advanced, which is to say this was buying a straddle rather than a call, so we didn't make a directional bet. Now let's look to our third pre-earnings trade. This is going to get a step even more advanced, and I would consider this next trade we're going to look at together to be expert level option trading. We're going to look at a trade that is delta neutral, earnings neutral, and much closer to volatility neutral. A quick disclaimer here. For those of us that don't like trading compound option strategies, or simply don't feel like we have the background to try, that's okay. We're only going to discuss this for the next 60 seconds, and while it's a great use case, for the vast majority of us, there really is no need to even consider this approach if it feels too complex. The Trade Machine was designed to make trade analysis easy and fast, and we'll be through this example very quickly. Now for you option experts, here we go. We're going to use a pro feature, which is a custom strategy. So click custom and click add. We're going to want to buy an at-the-money straddle that expires in 30 days. So a call and a put. And we're going to want to sell an at-the-money straddle in the weekly options. So again, we're buying an at-the-money straddle with the 30-day options. We're selling an at-the-money straddle with the weekly options. We're going to close the entire trade together, so we're going to check this box. Let's give the strategy a name. We'll call it a long-short straddle, and then we save it. Now remember, we're still looking at this very short window, specifically opening the trade 6 days before earnings and closing on the day of earnings, again, These stocks report earnings after the market closes, so a 0 is okay here. If any of these stocks reported before the market opened, we'd have to put a 1 here. Let's go ahead and do this for all of FANG. And here are the results over 2 years. It's pretty clear now that we should be focusing on Amazon, which has won all 8 times with a 207% return. But this is actually a strategy where we would want more data rather than less. This is not about momentum, but about a volatility pricing mechanism or a volatility scalp. So now we take a little bit more data and we'll look at 3 years. Let's focus on Amazon. Now, this trade should not vacillate a lot, and if it does, we have made the wrong bet and we're gonna wanna exit. So let's tighten our stops and our limits down to 20% each. That is, if the strategy is up 20% within the 6-day period, we'll close it. And if the strategy is down 20% within the 6-day period, we'll close it. All of a sudden, we have a trade that takes no stock direction bet, no earnings bet, almost no volatility bet, has extremely tight stops, and we see a 286% return with a 92% win rate. That is, it has won 11 of the last 12 earnings cycles. Of course, with every backtest, we can just click on the tile for details. Here we can see the 286% return in the strategy versus the stock. We can see the average win versus the average loss in dollar amounts, and the gross gain and gross loss. And of course, with the strategy that's this complex, you probably want to go trade by trade, download it into Excel, and do some further analysis. If this kind of trading fits your style, a trade that is delta neutral, that is it takes no stock direction risk, and it's relatively vol neutral, which is to say that it looks to scalp on the edges, you can find a treasure trove of data in the scanner as well. We'll go by strategy, we'll look at the S&P 500, we'll scroll down to our pre-earnings trades, and we'll look at the 6-day pre-earnings vol scalp. All of the trades have loaded. Here's our Amazon trade. Because we don't have a limit and a stop in the scanner, it shows that it wins 10 times and loses 2 times as opposed to 11 to 1. You can also see Baidu. You can see Alibaba. You can see Micron. You can see Federal Express. You'll note there are only 56 results in the entire S&P 500 for this scan. This is a difficult trade to find and takes relatively low risk. You'll also note that as we look at this scan, we only have 3 years turned on. You can feel free to look at any time period, but this is a trade where I like as much data as possible. And now we have our pre-earnings trade for Amazon, and before we found the trade for Apple, and then before that we found it for Alphabet and Facebook. Here they are. We should consider them not one at a time, but rather as a portfolio to manage risk. We're taking delta bets, we're taking volatility bets, and then we're taking a volatility scalp. All right, now it's time to look at the periods right after earnings. Everything we've done so far has either been long volatility or been vol neutral. Let's look at a short volatility trade now. We will look at selling an iron condor. So we will put all the FANG stocks back in here. We'll go to iron condor, we'll go to short, we'll go to our custom earnings, and now we want to open a trade that starts 2 days after earnings and closes the 3 weeks after earnings. So we're looking at a 19-day trade. It's essentially a 3-week trade after earnings. We'll come back down into our close trade when section, and we'll put our limit gain of 40% and our stop loss at 40%. We'll look at 3 years, and since we're doing a 21-day trade, we'll look at 30-day options. And here are the results. This trade benefits if the stock doesn't move very much for the 3 weeks after earnings. This is a short volatility trade. And we can see that it's not a very good trade for Amazon, Google, Apple, or Netflix. But Facebook stands out with 11 wins out of the last 12 earnings sessions for a 353% return. And if we click on that back test, we can see the average return in this 19-day period was 25%. We can see the average winning trade was 30%. The average losing trade was 32%. It has just won almost every time in the past. Having a short volatility position after earnings is a great hedge to a portfolio that may be long volatility, that is long calls or long straddles ahead of earnings, in order to isolate the patterns in the trades you're trying to find without being overly concentrated in a single type of trade, that is a single type of position. So when trading options, it's a good idea to have positions which are long volatility, that's long options, and short volatility, that's short options. Now we have our first post-earnings trade, and this is also our first short volatility trade. And by now we all know that there is no magic. We can go to the Pros scanner. Under ticker group, we'll just look at the NASDAQ 100. We'll now come under the post-earnings section. We'll select the 21 days post-earnings short iron condor, and we can see the top result is none other than Facebook with a 25% average trade return, 11 wins, and 1 loss. Now, if you're feeling a little bit like Alice in Wonderland falling down the rabbit hole from information overload, please don't. We're now going to turn to the scanner and we'll tie everything together and illustrate once and for all that the information asymmetry that has benefited the top institutions and their clients at the expense of everyone else has now been broken. Before going over the advanced features of the scanner, we can take a step back. If you look at the Buy Strategy tab, you can see that we have some of the most common strategies that have nothing to do with earnings. These strategies are done just avoiding earnings. Everything from covered calls to short put spreads and long straddles. So for example, you can find the best covered call candidates. In our only trade earnings section, we do have the ultra risky but still common strategy of buying strangles during earnings. This is a straight down the middle bet that the stock is going to move a lot off of earnings. In our post earnings section, we looked at just one, which was the short iron condor 21 days after earnings, which is just a fancy way of saying selling covered options after earnings. But we also have the 1 month short put spread after earnings and a 1 week long straddle. And then of course we have our pre-earnings trades. We have the 3, 7, and 14-day pre-earnings long calls, which takes advantage of the remarkable pre-earnings optimism in this bull market. But we also have two strategies which take no stock direction risk at all. The 6-day pre-earnings volatility scalp, which we looked at with Amazon, takes no stock direction risk. The 6-day pre-earnings long straddle that we looked at with Apple takes no stock direction risk either. For those that are new to Trade Machine, we note a gentle reminder that of course you can feel free to test any strategy you like. There's no limit to the ideas you can test, but we've built a scanner with boundaries that cover all sorts of trades. But we've gone further. For each of these strategies, we have a full-blown dossier which discusses the way the trade is placed and most importantly, the rationale behind it. This is critical because just testing a million strategies and picking ones that seem like they have big win rates is misleading. It's oftentimes called spurious for those that like math jargon. Every trade idea has to have a reasonable hypothesis, that is a reason that it could work, and then we test that hypothesis scientifically. Each of these strategies meet that criteria. You can access the brief dossier on each one of these strategies by simply going to the Discover tab, and in a few paragraphs, all of a sudden the entire world of options will open up to you for each of these strategies one by one. You'll understand why such a trade could work and what the belief system is if you place the trade. Now let's dive into the scanner. Through our use cases, we've touched on the features, but now we can be really precise. Let's step away from the strategy tab and look at the buy ticker functionality. So we'll click on buy ticker. You can enter up to 100 tickers in this box, separated by a comma, to create your own custom portfolio of stocks you like to scan. If you're using Google Chrome, you can actually reshape this text box, but if not, it doesn't really matter. Just enter a comma-delimited list and you'll get your results. And if you're wondering how I find all of these great trades for our members that have worked out so well, this is the magic I was using, and now we're making it available to everyone else. I like to start looking at 3-year back tests, but you can feel free to look at any and all back test lengths. Then I like to sort by win rate, which is the default functionality of the scanner. And what I'm really looking for is a portfolio of trades. So I'm okay with trades that take a stock directional bias, like the pre-earnings momentum trades, as long as I have other trades which don't take a stock direction bias. And I'm also okay with owning volatility in some trades, like the pre-earnings Apple straddle, as long as I'm also taking strategies which sell volatility. Let's look at how the trades with win rates over 80% already have created a diversified portfolio of trades. The first trade is the Facebook pre-earnings volatility scalp that we looked at. This is a trade that takes no stock direction risk. The second trade is the pre-earnings call in NVDA. This takes stock direction risk. And then we look at Apple, 1 month after earnings, selling a put spread. This is a short volatility trade and a slightly bullish trade. Then we have Facebook. This is the 21 days after earnings, selling the short iron condor. This trade takes no stock direction risk. Then we have a pre-earnings trade in Amazon, which is long volatility. And then we have the after earnings straddle in Google, which takes no stock direction risk. Then we go back to Amazon for the pre-earnings volatility scalp, which takes no stock direction risk. And the last trade is another bullish bet to pair with the NVIDIA trade. It's a straight down the middle 3-day trade, which buys the call before Netflix earnings. So just using our group of 6 common tickers and sorting them by the win rate, we've actually found a portfolio of trades which take on almost every position. And of course, if you ever want to see any of these trades live, all you have to do is tap on the strategy and you can see the trade. This is the 1 week pre-earnings long call in NVIDIA. And now for the final data point, Trade Machine now has earnings estimates. So while you're doing your scans for pre or post earnings trading, or simply for normal trades like a covered call trying to avoid earnings, you can scan for the earnings dates. Our earnings provider is called Wall Street Horizon, and they are the definitive source for institutional earnings dates. All right, we went pretty fast, But even just limiting ourselves to a handful of stocks, we found great trading opportunities surrounding earnings. We found that we could play momentum optimism in long calls for Google and Facebook 2 weeks before earnings. We found a delta neutral volatility momentum trade, which was long an Apple straddle 1 week before earnings. We found a volatility scalp in Amazon with a sophisticated long straddle short straddle play. But remember, none of these trades stayed open during the earnings event. Remember that. These are not earnings coin flips. After earnings, we found other possibilities. We saw that selling the volatility in Facebook was a winner. Now, of course, we just focused on earnings related trades. If you like trading the actual event, we have a button for that. You can just click only trade earnings and test any strategy you want, whether it be custom or pre-built during the earnings event. And of course, for all other times, you can always just select never trade earnings and you can do the same thing. You can create your own custom strategy or pre-built strategies. And finally, it bears repeating, while we just looked at the FANG stocks, we cover every stock and every ETF and every index in North America as well. The opportunities are there. You just need to find them. So this is it. This is how people profit from the option market. It's preparation, not luck. Thanks for watching.